Hi there, and welcome to another video in the Uncovering Academia series, in which I look into different papers in academia in the field of finance and economics and try to find different ideas, different subjects that would apply to any practitioner and try to just break things down in, I won't say layman terms, but in common terms. Today I'll be talking about cost of capital, a very big deal, very big idea in terms of valuing companies, corporate finance, and a paper I came across that says that the market might actually imply a certain cost of capital, which may save us a lot of time in trying to figure out this certain number. So with that in mind, let's get started. I will be analyzing two different papers. The main one I'll be analyzing is evaluating implied cost of capital estimates. And this is the main paper I looked into, in which there's multiple ways to find an implied cost of capital. So they essentially, the researchers here analyzed all those different methods and tried to see which methods were the best. So another thing I looked into was the implied cost of capital, a new approach. And in this paper, what's actually interesting is they find ways to forecast financials further down the road in a certain formula that becomes very helpful in evaluating cost of capital estimates. So the methodology for the main paper we'll be analyzing comes in essentially two ways for analyzing robustness. It's predictability, which means it helps you better forecast realized returns, and tracking, as in the implied cost of capital today kind of tell you what's going to happen tomorrow, a couple of years down the road maybe. Now the method that was used for assessing the robustness for the implied cost of capital looked over 80,000 firms from 1970 to 2007. Forecast earnings implementing the model produced from the second study I mentioned. And the reason I used the second study was, first, the results closely correlated with analyst estimates without the forecasting bias. As in, after earnings estimates, analysts usually increase their forecast, and after a certain company doesn't meet the estimates, they bring it down. So it kind of canceled that part out. Allows for firms without analyst coverage or sketchy analyst coverage. Sometimes they're covered, some years they're not. And can be used for forecasting beyond 1 to 2 years, which is what equity research analysts mainly focus on. And they tested 7 different measures of implied cost of capital. I didn't know there was 7. I only was thinking there was 1 or 2. So let's go through the 7. They actually kind of fit into 3 different buckets. First bucket is the Gordon growth model, in which the firm value is based on the present value of expected dividends, which used to be the mantra for investing in the first place. It includes a terminal value period, which means you might forecast for a certain amount of time, a fixed period, and then, because you can't forecast 100 years into the future, you just put a terminal value to understand what would the value of the firm be further out into the future. And you consider 2 versions of the model. One is just 1 period out, and with the 1 period out, it's the main equation known, at least in financial theory, which is you put earnings per share or dividends divided by the discount rate minus the growth rate. And you also have a second variation of that used, which is you essentially forecast 5 years out, and then you find a terminal period based on that. Now the benefit of this model is it's the basis for financial theory, and kind of a similar idea used in the DCF calculation in assessing valuation for a company. And 1 period can easily be calculated. That's one benefit. The second bucket here is the residual income model, in which the firm value is based on a clean surplus relationship between net income and book value. If you think about it in accounting terms, book value without any extra things added to it, book value equals increase in net income minus dividends. So the more you can increase net income and not increase dividends nearly as much or hold dividends stagnant, you should be able to increase book value and therefore increase the value of the firm. It's accounting based, and actually in their models they forecast 12 years, which to me is kind of a long to forecast, but hey, whatever works for you works for you. Now, the benefit of this model is that you can clearly see the relationship between the market and book value. It's the standard way of looking at a company in terms of financial studies in academia. So you can clearly see this is the book value, this is what it's worth today, and this is what the market is placing it at, and understand those differences. Also, in using this type of model, you can clearly see industry-based profitability estimates. If this company is bringing in, will have this certain margin in net income, you can compare that to the industry they're in, and over that forecasting period, adjust up or down to meet industry standards. Then the third and last bucket is abnormal earnings growth models, in which the firm value is based on forecasted capitalized abnormal earnings. And what I mean by abnormal earnings is that earnings that are above the industry average. Just going back to what I just mentioned about residual income model, there's maybe a certain profitability margin, maybe margin on earnings, and how much above or below you are to the industry. That's really where your value comes from. And there's 4 different variations. One, well, really 2. Something that's highly used and becomes standard practice, which is the PEG ratio. And in their study, in their experiment, they're looking at 2 different versions. One is the standard PEG ratio. The other one is a modified ratio. The third one used is they base it off of a certain calculation, a more specialized calculation for long-term growth. And the last one is you look at the long-term growth prospects, and then you use that to forecast the short-term growth. So an example of this is 5 years from now, you expect a company to grow earnings at a CAGR of 10%. Well, it's not going to grow straight line at 10%. In the beginning, it might grow at 15, 18% the first year or two, and then by the 5th year, it's probably only growing at 6 or 7%. But if you find the average overall, it looks like it's growing at 10% a year. So the benefit of these models is PEG is highly touted, and in some people's eyes, an industry standard. It's still used by investors today. Whenever you look up a quote for a stock or trying to understand their valuation, the PEG ratio is always mentioned, and the models can actually look at various times in the future. So these are all the models. Here are the results. Implied cost of capital results are similar to traditional market risk premium measures. As in, you can maybe just look at a 1-factor, maybe 2, 3-factor models, all those models that Fama and French has come up with over time, and you will get similar results. But then there's a little bit of a turn. Both the Gordon growth models estimates are the most predictable for future returns, and it's even more persistent over longer time periods. As in, if you look at those models alone, you can actually kind of get an idea of the long-term returns of a stock. And a few of the abnormal earnings models aren't very useful for predicting returns. It's kind of a little bit disappointing, especially since they're highly touted, especially PEG. PEG is a way to view value and growth at the same time, but in predicting returns is not that useful. And there's a level of tracking, as in you look at the cost of capital now, and it kind of helps you predict what the cost of capital will be in the future. It's found in some residual income models, well, one of the residual income models as well as one of the Gordon growth models. And once again, abnormal earnings models don't really help with tracking ability either. Firm level implied risk premium is strongest with ERP, which is a Gordon growth model for predictability, and GGM, which is another Gordon growth model for tracking, which means the Gordon growth model is really hitting all strides here, and industry implied risk premium can be used to predict firm level returns. maybe better to look at implied cost of capital from an industry perspective instead of at a firm perspective. Implications here, as I mentioned before, using industry-based measures can be used for investment and capital budgeting decisions. The Gordon growth model is the most powerful tool in understanding the market, which means it can be used in an inverse way to back into implied cost of capital. And you can even use this idea that's used in the American Society of Appraisers. And one of the things they teach you to do is use the inverse forward PE and plug in a long-term growth rate and see where would the discount rate be or the cost of capital be once you do those measures. And what this study is kind of concluding is that this is a good idea. You can do that. And most abnormal earnings models aren't very useful. It's probably why take out the traditional measure of the PEG ratio. Those other models are really used in practice. And I don't know how useful, other than Peter Lynch, how useful or how many other investors actually really use the PEG ratio. Now, what would I like to add to this topic? How would I like to contribute to the literature here? I would actually like to use free cash flow instead of earnings per share or dividends in understanding implied cost of capital. I know that'll make things a little bit tougher, but I am a huge fan of free cash flow. It explains so much to me. I think it's the main basis for understanding any company, how their free cash flow will grow over time. Also, would like to know the optimal investment horizon using implied cost of capital measures here, because you just can't invest and expect, over a year or two, these expected returns will come into fruition. You got to understand exactly what time periods are we looking at here. What's the best time period? What's the worst time period? And of course, I have come up with my own kind of theory about valuation called the present value of growth opportunities, or PVGO thought process. And there's some questions I would like to have answered that relate to that, which is using other benefit streams other than earnings per share or even free cash flow or dividends. What about operating earnings? What about sales? And potentially adjusting implied cost of capital for each benefit stream. So how about if we're going to use sales, for example, how about in evaluating a company, you adjust the discount rate for that benefit stream? Just another idea. Thank you so much for your time. Hope you got a lot out of this video. I know I surely did in understanding the subject, and to be honest, it's kind of changed the way I looked at discount rates. Realize they're not as complicated as we make them out to be, so it will definitely help me when evaluating companies, as you will see later on in the next couple of videos I will post in terms of evaluating companies. You'll see a difference in the way I calculate the cost of capital. And overall, just whatever ideas you see fit that relates to the subject, drop them in the comments section below. And until the next time, thank you so much.